Now, I think there's two answers to your question. The first one is that actually when we look at, let's say, US versus Eurozone equities, actually what we've seen is that over the last couple of months, the much lower euro, so the depreciation of the euro was helping Eurozone earnings. So actually Eurozone earnings revisions went up relative to the US. But actually, Eurozone equities continued to underperform. So in reality, the gap between Eurozone and US equity valuations has widened dramatically, right? So Eurozone equities look very, very cheap versus the US now. And the same also for emerging markets, more broadly versus developed markets. When we look at that, and you can look at whatever you want, whether that is dividend yield, price to book, price to earnings, doesn't matter. Across the board, there is an extreme gap to that. That is the first answer to the question. The second answer to the question is valuation is a very, very poor tactical asset allocation tool. So even though that might look cheap, that doesn't tell us that the next 3 months, even the next 6 months, that stuff is going to outperform miraculously. It does tell us that perhaps over a longer time period, over 5 to 10 years, that Eurozone equities, emerging markets, perhaps strategically look more attractive now, but tactically 3 to 6 months, that is a very, very different question.
It's a great truism, isn't it? Valuation's a poor tactical allocation tool. I like that, Max. In terms of what you were talking about, that variance, though, in the value of US equities versus Europe and elsewhere, we have to be careful, don't we? Because as I pointed out earlier on the show and in previous shows as well, there are enormous numbers of US stocks, not just in technology, but in the broader S&P 500, that are either in correction territory or in outright bear market territory. We perhaps need to differentiate a little bit more.
Yes, absolutely. I think what we are missing is that beneath the surface, there is an awful lot going on. You mentioned at the beginning the airlines. Look at US airlines at the index. It's actually flat year to date. Who would have thought 12 months ago, with vaccines, we would have all thought, OK, that's the reopening trade. That's the stuff that we need to go long. There is an awful lot, not only in EM or in Japan, but also in the US, also in the Eurozone, that actually is trading, like you said, in bear market or in correction territory, at least down 10%. And what that, again, tells us that the actual positioning, the actual sentiment is not as bullish as the index level suggests to us, right? It does tell us that people are massively differentiating. They're differentiating between companies that make money, that have exceeded expectations in the last 2 earnings seasons, that are either in the reopening category or in the lockdown category, for example, right? They're differentiating between the value category or the growth category. So there is an awful lot of differentiation going on beneath the surface. For multi-asset guys like myself, it's fairly easy. We just say, I buy the US, I don't like anything else. That's easy. If you're an equity manager, it is bloody difficult. It is very, very difficult because it basically means you have a handful of stocks that deliver most of the gains, but you can't, that they're already such an enormous degree of market cap. You can't go even more long than that. So it is an extremely challenging environment for active portfolio managers, particularly in the equity market.
Max, final one for me. Emerging markets, you were talking about the valuation discount compared with DM there as well, the developed markets as well. Is that warranted, though, given the dollar exposure and concerns, of course, about US rate rise and what that historically can mean in terms of carry, in terms of valuation of your EM assets?
Yeah, I do think perhaps tactically it's not the particularly right place to be, but I do think if we look at 2022 overall, I think EM equities could actually be quite a nice surprise candidate. We have an awful lot of bullish dollar views for 2022. Actually, positioning on the dollar is quite long already on our measures, right? We have, of course, the fears around China's zero COVID policy. That is a bit overblown, right? But we do have now China's credit impulse being negative. Perhaps that is recovering a little bit, particularly towards the second half of 2022. And all that should actually allow, I think, emerging market equities, not in the next couple of weeks, but 2022 overall, perhaps from Q2 and particularly the second half overall, that should allow actually emerging market equities to be somewhat of a positive surprise candidate.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.